So we are going to discuss major areas according to how the UPSC has a habit of asking. We'll focus on the core areas, and in a couple of sessions we'll try covering all the most important happenings of the previous year. And me myself, Mohammed Shafi. To start, we'll have a look at this thing called as CBDC. Over the past couple of years, there has been a lot of emphasis on this particular thing called as CBDC, digital currency, etc., etc. What is this thing called as CBDC? CBDC stands for Central Bank Digital Currency. The central bank's digital currency. We have been hearing about digital currencies for quite a long time, especially the Bitcoin, so the cryptocurrencies, the Bitcoin, Ethereum, Ripple, all these sort of things. So it is in this context something like a central bank digital currency becomes important. Now, how is a CBDC? What is basically CBDC? It is a legal tender issued by the central bank in a digital form. So this is something that has a legal backing. So if you're familiar with this idea of cryptocurrency or Bitcoins, you know this does not have any legal backing. Some decentralized mechanism creates these cryptocurrencies and they operate as such and outside the purview of the governments, jurisdictions, etc., etc. But here, there is a central government which gives it a legal backing, which makes it a fiat currency. With respect to the value of that currency is fiat currency. For example, if the Indian Reserve Bank of India is going to issue a central bank digital currency, that currency will have some relation with the existing paper currency that we have. So it will be like one, whatever, let's assume you introduce a new unit of a CBDC, they will say one CBDC is equal to 100 rupees. So there will be some form of a relationship that exists. Whereas in the case of cryptocurrencies and all, you do not have a stable relationship. It is an unstable relationship. It keeps fluctuating all over the period. So this is the basic idea. Now, you have the CBDC on the one hand, you have the private cryptocurrencies on the other hand. We'll have a look at the comparisons of those. We'll try to look how is one different from the other. On the one hand, we'll start with private cryptocurrencies and why it would CBDC an improvement over those. And both of this works on the same technology platform, which is the blockchain technology. I hope all of you must be familiar with the blockchain technology by now. What is the idea of a blockchain technology? How does the decentralized ledger mechanism works at all? The most important feature of a private cryptocurrency is that it is a decentralized currency. A centralized currency is something that is issued by a central authority. If a central authority like the central bank or the central government issues a currency, that's an example of a centralized currency. Whereas a private cryptocurrency is not issued by some central authority. It gets created on a platform and by you call it the Bitcoin minings, right? As a result of mining some basic coding processes, this keeps on creating and no central authority have a control over this. Another problem is the volatile nature. See, this is considered as a speculative investment. If you are well versed with the idea of the concept of money, we have in the discussion in our classes on money and all, we have a discussion about the functions of money. So one function of money is what you call as a speculative function of money. What is a speculative function of money? Suppose I have, let's say, 10 lakh rupees. I go invest it in stocks and buy stocks worth 10 lakh rupees. After a period of time, let's say around after 1 year, I sell the same stocks for around 12 lakh rupees. I make a profit of 2 lakh 20%. So why did I invest in the stocks? Is it because I wanted the economy to grow? Or is it because I wanted the betterment of some company? No, it's because I wanted to make some money out of it. This is the whole idea of speculation. You invest in something, you put your money in something just on the assumption that its prices will go up and so that you can make money in the process. Not go up only, it can go the other way around also. So there is the both ways you can make money. So this is the basic idea. Now, in today's context, cryptocurrencies are becoming more and more popular, but still they're not as popular as the conventional currencies. So people holding conventional currencies are considering cryptocurrencies as an investment option. They think that this is going to be the asset of the future. So if I get hold of some cryptocurrencies today, I'll be able to make so much money in the future. So they buy these cryptocurrencies and do the speculative investment. Now, what happens in the speculation is something happens, some exogenous factors, as a result of which something happens to the economy. The prices of the cryptocurrencies will crash, and as a result, the people will lose their money. That's what the disadvantage of this volatile nature is. In the case of rupee and all, there is some central authority to make sure the prices do not fluctuate beyond a point, but that central authority is lacking in the case of cryptocurrencies. What of the supply? You do not have the provision of unlimited supply in cryptocurrencies. You only have a very limited supply. So you have this mining, and there is an upper limit to whichever cryptocurrency it is, be it Bitcoin, Ethereum, Ripple, Petro, whatever it is. There is an upper limit to which what's the maximum amount of cryptocurrencies that can be supplied. Now, it offers a higher privacy and anonymity. And this is one very important aspect of cryptocurrencies, which is actually pulling a lot of people, maybe the people dealing in the dark web or the people dealing with all the types of illegal mechanisms to use cryptocurrencies rather than using the conventional currencies that we have. The conventional currency or the money that flows through the banks, the biggest problem is if I transfer my money to someone, there is always a trail. If I transfer my money to buy some weapons, the law enforcement agencies will be able to identify where this money came from. But in case of cryptocurrencies, that's not possible. If there's a total anonymity, there is a privacy. And that's a feature of them. You have certain examples of those. Now, compared to the private cryptocurrencies, what is the difference that a CBDC has? It is issued by a central authority. When it is issued by a central authority, the central authority has the power to reduce its volatility. The cryptocurrencies now being extremely volatile, the volatility can be reduced. So the fluctuations can be reduced. You can make sure that people does not disproportionately lose out on their money. The supply is also actually very much flexible because the government, if you are aware of our monetary policy mechanisms and all, the Reserve Bank of India controls the money money supply in the economy through its measures, the policy instruments. So similarly, if it's a CBDC, the government have an idea about what is the amount of currency. They can use the policy instruments to change its supply depending upon the demand in the market. The privacy and the anonymity component will anyway be lower because that's the only way you can keep trailing of all these things. Nations like Nigeria has introduced something called as e-Naira, which is an example of a CBDC. So why is this important in the context of India? Because the Indian government has in the last budget said, we are going to introduce a CBDC, but nothing much on that has come up, but it will come up in the future. We are expecting it to come up in the future. Not this budget, the previous budget. Now, you just have a look at the inflation targeting mechanism in India. How is inflation targeting actually carried out in India? It is carried out with the help of Monetary Policy Committee. So whenever the Monetary Policy Committee tries to increase the repo rate or reduce the repo rate or the CRR or SLR, they have an assumption that this much money is available in the market. So if you are increasing the CRR or like if you are increasing the repo rate, if X is the amount of money in the market, a portion of it will be reduced. Let's assume that is Y. So they will assume that they will now be able to reduce the amount of money supply. But when there is a whole lot of private currencies which the government does not have any idea about, the Reserve Bank calculations can go awry. So any attempt of the Reserve Bank to control inflation in an economy where there is a whole lot of private cryptocurrencies on whose quantity the central bank does not have any data about, the inflation targeting mechanism fails. So that is why the central bank is actually pushing for a central government-backed digital currency rather than the private cryptocurrency. Obviously, the cryptocurrency has so many advantages and it has so much potential, and that is the reason why people are preferring this private cryptocurrencies. So what the central bank is saying now is, see, you instead of going for a private cryptocurrency on which we do not have no idea about, you come and invest in a government-backed CBDC. So in that case, you will be able, the government will be able to have a more control of the economy. Otherwise, the whole operations of monetary policies fails. The cryptocurrency actually is a subset of a class of assets which is called as VDAs or virtual digital assets. If you have a look at the last budget, not this year's budget, again the previous year's budget, the budget says about taxing VDAs or the virtual digital assets. So they say that there will be tax deducted at source of 1%, which will be levied on payments towards the virtual digital assets or cryptocurrencies beyond 10,000 in a year. So virtual digital assets include these cryptocurrencies, obviously. And in addition, they have these things, the new fashionable investment of the NFTs or the non-fungible tokens and all that's coming up over here. So the government is planning to tax these things. The government is understanding there is a lot of potential taxable amount that lies in all these assets, and the government is trying to capitulate on that. Now, under the IT Act of 1961, the government has defined the virtual digital asset as VDA as any information or a code. This can be any information or a code or a number or a token which is generated through cryptographic means, like the encryption, the cryptographic means, or otherwise, and which can be transferred, stored, or traded electronically. So the government is saying, if you are doing some sort of this trading, and if you're getting some money, 1% has to be given to the income tax department as a tax deducted source. Now, we have said what are the risks associated with something like cryptocurrency. They're highly risky assets. They are largely unregulated. So, if an individual, since it's unregulated, if an individual loses a huge sums of money in this process, there is no rescue mechanism. There is no place this person can actually go to. And also, it undermines the role of the RBI's monetary policy influence, etc., etc. And there is a term called as dollarization. The term dollarization and the term de-dollarization could be important. Dollarization and de-dollarization. Dollarization is the process in which dollar is becoming more and more prominent. It means basically the increasing use of dollar in your domestic economy. Suppose if you are increasing the use of dollar in India, that's an example of a dollarization. See, this increasing use of the dollar could be in addition to the existing rupee, or it could be by replacing a portion of the transaction that happens in rupee. Whatever it be, if the dollar transactions are increasing, that's called as a dollarization. But now the Indian government is promoting something called as de-dollarization, or it is very similar to say the government is promoting something like internationalization of rupee. So what is this thing called as de-dollarization and internationalization of rupee? So government wants to reduce the importance of the dollar in the Indian economy. So any transaction, international transaction which is happening now basically happens on the dollar-based exchange system. So government wants to reduce its importance and government wants to bring in rupee at the center of it. And that's what the government is saying when they speak about the internationalization of rupee or de-dollarization. The advantage of this is basically that the government need not be concerned much about foreign exchange. It can be, it gives more importance, like it reduces the foreign exchange currency related risks and all. Now, another disadvantage or the risk associated with a cryptocurrency is its anonymous use, for making it liable to be used for aspects like terrorist financing, money laundering, drug trafficking, etc., etc. Thus, we are done with the portion on the virtual digital assets, largely focusing on the cryptocurrencies and the government CBDC mechanisms. So now, next what we are going to have a look at is something called as UCBs, or the urban cooperative banks, or largely the cooperative banks. This type of banks, like the cooperative banks, the regional rural banks, the small finance bank, those banks which have been established particularly to promote financial inclusion. There are certain banks like that. So that's the whole purpose of having an RRB, SFB and all. These banks are one of the favorite areas of UPSC to ask question about. Financial inclusion is one of UPSC's hottest topic when it comes to the prelims examination. So all these type of banks, the urban cooperative banks, what has happened to them recently, the SFBs, the RRBs, you have to be very clear about their regulatory mechanisms, the priority sector lending norms, what they do, etc., etc. Now, there was an NS Vishwanathan panel, which was an expert committee to study about the urban cooperative banks. Why was it important that we study the urban cooperative banks? Because if you have been following news, there was a case of a Punjab and Maharashtra cooperative bank. Then there was another bank, or Karur cooperative bank. So we see a large number of cooperative banks failing in India. So the cooperative banks historically had a problem of poor regulation. They were regulated by multiple authorities. When any individual or an entity is regulated by multiple authorities, the problem is that there will be no proper accountability. So if suppose I and my friend is regulating something, or I and some other person, I'll not use the term friend over here, I and some other person is regulating something. If something fails, people will come to me and blame me, then I will say it's not my fault, it's this guy's fault. When the people go to that person will say it's not their fault, it's my fault. So, but instead, if there is only one person, I cannot push the blame. I have to take the accountability. I have to be responsible. So this is one problem that has been existing in the urban cooperative banks for quite a long time. There has been multiple regulatory bodies, and no one was there to take accountability. And that's why the government tried to change its regulatory structure. Now what has happened is the urban cooperative banks are now regulated by RBI, which was not the case earlier. Now the urban cooperative banks are regulated by Reserve Bank of India. And this was a 2021 prelims question as well. We'll have a look at certain common banks, the urban cooperative bank, the nationalized banks, the small finance bank, and also the regional rural banks. What are their main differences? The main differences only we'll focus. But if you want to have a look at the detailed analysis of it, we have done it so splendidly and in detail in our classes on banking. Please go watch our classes. That would be really helpful. Now, you have capital adequacy. Regarding capital adequacy, the urban cooperative banks are still under Basel 1. I hope you should be knowing what is Basel 1, Basel 2, Basel 3 are. So Basel 1 speaks only about credit risk. Again, if you want a detailed analysis of this Basel norms, the same classes on banking will help you out. So there is this thing called as credit risk, that the only risk that the Basel 1 norms are concerned about is about the loan not being repaid. The UCBs are still under Basel 1 and they're concerned only about credit risk. Whereas the nationalized bank, they are under Basel 3 and they have three risks: the credit risk, the market risk, the operational risk. Operational risk could be something that arises out of operations. For example, if some software goes bad, something of that sort. Market risk is something, what if the market of what the financial entities are doing is basically a market activity. So what if the market goes shut? That's the idea over there. I don't want to go into too much detail because that has been already done. Now, the small finance banks are under Basel 2, but they are also concerned only about the credit risk. The regional rural banks are also under Basel 1. Now, the question is whether these type of banks can open a branch at their will, a new branch at their will. So when it comes to urban cooperative banks, the urban cooperative banks which meet the FSWM criteria, will explain what is FSWM criteria. This is something relatively newer. The financially sound and well managed criteria. If you are someone who meets this criteria, you can start a new branch. On the other hand, if it's an urban nationalized bank, see, if a bank like SBI or a Canara Bank or a federal bank wants to open a new branch, they did not take the permission of RBI and all. They can just straight away go and start it. So is the case with a small finance bank. But when it comes to regional rural banks, they are regional in nature. So if the license itself is being issued considering their regionality, so if they want to go beyond the region, they need to get an approval. So UCBs and RRBs, there are certain restrictions upon opening new branches, whereas those does not apply in case of nationalized banks as well as the small finance bank. Now, same happens for the extension of the area application, very similar conditions. What about priority sector lending? This is something you should be by hearting because this could be a potential question for any prelims to come. So regarding the priority sector lending norms, the urban cooperative banks are expected to lend around 75% of their adjusted net bank credit to priority sectors, whereas the same is only 40% for the nationalized bank. For these small finance banks or the regional rural banks or the urban cooperative banks, this figure is as high as 75%. Why is this figure as high as 75% for these three type of banks? The reason is that these banks are formed exclusively to promote financial inclusion. So PSL is a measure that actually improves financial inclusion. So a bank or an entity that has been set up to promote financial inclusion, it is sensible to ask them to indulge in some measures that promotes financial inclusion more aggressively. So what is this FSWM that we were speaking about? So this says that the capital adequacy ratio should be at least above 1% above the CRAR applicable to a UCP. I hope you should be knowing all this capital adequacy ratio, CRAR. I'll just say the formula for the time being. Capital adequacy ratio, CAR or CRAR, both are the same things only. CRAR would be capital to risk weighted assets ratio, assets adequacy ratio, CRAR. Now, what is the formula for a CRAR or a CAR? It is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets. You just keep the formula in your mind. If you want a detailed explanation, again, our classes on banking will help you out. Tier 1 capital plus Tier 2 capital divided by risk-weighted assets is what you call a CAR or CRAR. So, if you are to be a financially sound and well-managed entity, that means your CAR ratio should be at least 1% above that of your minimum threshold. And this applies only in case of urban cooperative banks. And also, the FSWM would say your net NPAs, the non-performing assets, should not be more than 3%. You should have reported net profit in at least 3 out of your 4 preceding years. That's if I take the 4 past years of a bank, financial years of this bank, they should have profit in at least 3 of them. You should not have made profit in the past year. You should not have defaulted on your CRR, SLR norms during the past year. And you should have independent professional directors sitting on your board. You should have fully implemented the core business solution. CBS is basically a system where all the banks are facing on the technical platform of the banks, you can say, the technical backend of all these banks where they are operating. So all these norms, if you have a look at it, these are indications of a bank which is stable, which means if you're a stable bank, you are financially stable or well managed, which means you have more liberty when it comes to opening new branches, expanding your area under operations and all. On the other hand, if you're an unstable bank, if you are not able to keep your minimum amount of reserves, if you are not able to make profit, so this does not bode well for that case. So you understand the difference. So that's the whole idea of having this FSWM in case of UCPs. This is apply for UCPs. Keep that in your mind. Now there are certain new banks coming up. One is the idea of these neobanks. They come under the category of the tag of challenger banks. What is basically a neobank? A neobank is a digital bank without any branches. See, a neobank and a DBU, that is a digital business unit that we are going to discuss, are two separate things. A digital banking unit, DBU, is a branch of an existing bank. So, for example, if SBI decides to start a digital unit of them, that's a DBU. Whereas neobank is entirely a new bank, fully online. It does not have any physical branches. That's the whole idea of a neobank. So SBI can still start a neobank, but SBI starting a neobank means after the formation, this bank and SBI are two separate banks. So if these two activities are managed under the same bank, then that is the digital business unit of that bank, SBI. Whereas if this create a separate entity, if SBI creates a separate entity for the online activities, then that's the case of a neobank. So you can't find a branch of a neobank. It's fully online. It is not available at any physical location. It's entirely online. Now, why is neobanks important? Because when you think about going online, your cost actually comes down. The banks do not have the staffing requirements of the banks are lower. The physical capital requirements are lower. When the physical capital requirements are lower, they need to have less rental expenses, all these type of expenses, which means the cost comes down. When the cost comes down, the bank will be able to provide cheaper services, which means they will be able to offer cheaper loans. They will be able to offer higher interest rate on deposits, etc., etc. This is based on the idea of leveraging the advantages of technology like artificial intelligence, etc. Now, they have entered the financial system with the tag of challenger banks. Challenger banks. So they're challenger banks because they're challenging the existing notion of the physical banks. The traditional banks are being challenged, and that's where these neobanks come over here. So in India, if you ask me for an example of a neobank, I can't give you an example because we don't have any actual neobank existing in India. But there are certain different mechanisms by which they can operate. In India, what happens is, in India, we have digital banking units, but not exactly these neobanks. But some people or even certain papers loosely call these digital banking units as neobanks. Because according to the norms, see, if you have a look at the RBI regulations, RBI would say any bank cannot be 100% digital. They should have at least one branch. That is the norm that RBI mandates. So when that is the case, neobanks are not regulatorily possible in India. So this is important. Neobanks are not technically or legally possible in India because if that has to happen, the RBI should amend its rules, which has not happened so far, but we are hoping that it might happen sometime soon. Now, so RBI is actually resolute in prioritizing the physical presence, and the RBI is now speaking about bank to banks. For example, RBI would go to speak to SBI, Punjab National Bank, all these banks, and would say, see, you have physical presence. Now you do one thing. You open a branch as well. But however, you have seen these things, Razorpay, Jupiter, Neo, Open, they are called as examples of neobanks. But definitionally speaking, they are not perfectly neobanks. Then what are they? We'll have a look into that. The neobanks have normally three modes of operations. So one form of operation is this thing called as non-licensed fintech firms that collaborate with the conventional banks. See, these people like Razorpay, Jupiter, Neo, they offer banking services, but they do not have a banking license. Without a banking license, if you are offering a banking services, you have to be either an informal sector entity or you should have some collaborations with a partner bank. So this is how they operate. Like they collaborate with some conventional bank and they use the guise or the license of the advantages of this bank having a license and they are running. So technically speaking, these are not perfectly independent banks because if I am a banker holding a license, if I am willing to collaborate with certain other bank for a neo bank, and these people are going to do that with my license, I will put stringent restrictions on those people. Otherwise, if those people do something bad, that's going to negatively affect me because they are still technically operating on my license. So that's how these people operate. So in other places, you have these traditional banks that are undertaking their digital initiative. This is not exactly a neobank. That's a DBU that we're speaking about. Now you have licensed neobank. See, I am a fintech platform. I go to RBI and say, see, I want to operate a neobank. I have the technical wherewithal for that. Please give me a license. So that's what a licensed neobank would say, but that is technically not possible in India so far. So this is a DB, or the digital business unit, that we are speaking about. They are specialized service endpoints with minimal infrastructure. They might have infrastructure, even if they have that's minimal, to cater to the needs of the last mile consumers. They can provide facilities like passbook printing, cash withdrawal, and bank balance, etc., all digitally. Now, all scheduled commercial banks in India are permitted to set up the digital banking units. However, the regional rural banks, payment banks, and local area banks are not allowed to set up the digital banking units. Okay. Now, that's about the neobanks and the DBUs. From that, we move on to the next topic of discussion. See, initially, I'm focusing more on the banking related issues. You could see in the current affair discussion, the banking, the aspects of money, inflation get disproportionate weightage. This disproportionate weightage is because if you have a look at your previous preliminary question papers, you can see exactly this disproportionate weightage in your question papers also. You have a whole lot of questions coming from aspects like money. You have a whole lot of questions coming from banking, all this type of thing. So, for example, every year on an average, you get above 5 questions. It has went up to till 9 or 10 questions purely from money and banking. 10 questions out of 100 means 10% of your NDA questions for the prelims is coming from one single module. We are not speaking about one subject, one single module. Even almost all years, we get money, banking. When I say money and banking, I'm considering the inflation aspect as well. Inflation, money, and banking. So every year, you're definitely getting 5 questions, which is one module will give you 5% of your prelims. All the other subjects and all the other modules of even economy combined are not like only the remaining 95%. So that actually gives you an idea about the importance of this particular topic or the single module. Now, the next aspect we're going to discuss is about something called as FSIB. It's the Financial Services Institutions Bureau. See, if you want to know about FSIB, you need to know about something called as BBB, or the Bank Boards Bureau, which has been existing in India for quite a long time. Not a long time, maybe 7 years, maybe 6-7 years. Now, you know, in 1969, the government comes up with this idea of nationalization of the banks. They nationalized 14 of the 20 major banks. In 1980, they followed the step further and nationalized it again. So government made a scheme called as a nationalized bank scheme, 1970 banks. So this scheme said about how the directors of the newly nationalized banks are going to be selected, how the director selection should happen. But this was a scheme that applied only to banks. You can look at the title, Nationalized Banks Management and Miscellaneous Provision Scheme. But however, the government did not set up a separate body for this process of the selection of directors, which happened only in 2016. In 2016, that's after the report of PJ Nayak committee, which was submitted, the government thought that it is very important to set up a committee of bankers, like profession. It should not be some random politician sitting somewhere who should be selecting the future heads of the banks, be it SBI, Punjab National Bank, etc., etc. It should be professionals. It should be professionals selecting professionals. And that's why you create a body of banking professionals called as the Bank Boards Bureau. They would select the profession, like the heads, the chiefs, the directors of banks, as well as insurance companies. If this story is so clear, now I have been speaking so long till now about banks only. But now when the BBB comes up, this speaks about you can select the directors and the chiefs of banks as well as insurance companies. Where does this insurance company come from? It comes out of nowhere. So once this BBB was set up as a result of the PJ Nayak committee's recommendations, they said it speaks about appointment of full-time directors as well as non-executive chairpersons of PSPs should be done by the Bank Boards Bureau, and the same should be existing for the state-owned financial institution like the LIC, General Insurance, etc., etc. It is basically an autonomous recommendatory body. This recommendatory bodies can at max do recommendation, and the final call is basically taken by the appointments committee on cabinet. However, recently this issue was taken. The insurance authorities were not happy with this because bankers would select who is to head the banks. That's fine, no issues on that. But insurance authorities or the people in the insurance sector was asking, how can the bankers select who is to head the insurance agency? It is our call. We should have a call on that. So if there is to be a body which is to combinedly select heads to the banks as well as the insurance agencies, there should be representatives of these insurance institutions over there, which was not existing. And that's why the court decided to intervene. And the court said that, see, this BBB is not legally viable because you say the original legislation actually speaks about appointment for banks, but you're doing it for public sector insurance companies. So the Delhi stepped down the power of the BBB to appoint the chiefs of the public sector insurance companies. However, BBB could still do the appointment for the banks. Now, so in this context, the government scrapped the Bank Boards Bureau and they introduced a new body which is called the Financial Sector Services Institutions Bureau. So this will have a chairperson who is nominated by the central government. The present chairperson is Manu Pratap Sharma. In addition to that, they will have two secretaries, one coming from the Department of Financial Services and the other coming from Department of Public Enterprises. See, all these state-run insurance companies are actually coming under the Department of Public Enterprises. So their secretary coming in means they get a representation. Also, there will be a chairman of the IRDAI. So that brings in an additional technical recommendation, like voice of the insurance companies. So that levels out the picture. And now this body, FSIB, is undertaking these appointment related recommendations for banks as well as public sector insurance companies. So in addition to this, there will be experts, 3 persons with subject knowledge experts relating to public sector banks and financial institutions, and 3 persons with subject matter relating to public sector institutions will be nominated by central government, will be there as part-time members, not the full-time members. So that's about BBB, FSIB, etc. Now we'll focus on as analysis on something called as account aggregators. What is this thing called as account aggregator, and who are this account aggregator? This has been in news for some time, but this has not come up in the like UPSC's line of questioning, but it will come up now, very soon, that's for sure. So what does an account aggregator do, and who is an account aggregator? See, suppose first thing you need to understand is this is a case of an NBFC, non-banking financial companies. Suppose I have different bank accounts in different NBFCs. I have bank accounts in, say, some like 10 NBFCs. So, like, not bank accounts, accounts in 10 NBFCs. I have deposited in some places. I have taken loans from some places, etc., etc., etc. So, I would wish actually to have all of this information to be visible in one place. So, you take, not everyone would wish that, but there would be a large amount of people who would wish. Otherwise, if I want to know, let's say I have an account in NBFC 1, NBFC 2, NBFC 3, 4, 5 till 10. If I want to know the status of my account in each of these NBFCs, I will have to individually go to these NBFCs and see what is the status of the account, how much money is there, all these things. What an account aggregator would do is, with my consent is very important, they would ask me consent and they would collect the data of all these 10 accounts that I hold. These 10 accounts are there in the accounts of different NBFCs. They would collect the data about all these NBFCs and they would aggregate the accounts and provide this entire information in one single platform. So this NBFC AA or an NBFC account aggregator is not an NBFC that provides banking services. It provides an information services, to be frank. So what they actually do is they take all this information and put together in one platform, and that's strictly based on consent. That's it. Now, for the time being, we are doing away with the banking aspects. Now we'll focus a bit on the inflation dynamics. We'll have to be very, because this is something that has received a lot of attention in the past year, not just 1 year, the past couple of years, to be frank, especially on the waves or the periods of post-COVID recovery. Now, there are many inflation indices. You should have an idea about who releases these indices and what these indices basically mean. To start with, you have a very, very common index which is called a CPI. I'm not going to explain what is CPI is and what is WPI is, because at this stage, when you're going to write your examinations in less than a month, I'm assuming you should definitely be well versed with what a CPI and a WPI is and what are the differences of those. However, we'll have a brief look at the weightages. That's fine, but the basic definitional part I'll go in, not go. In the CPI, you have CPR, CPU, CP All India, or this is also called as CPC. CPR stands for the CPI in the rural areas. CPU is the CPI in the or consumer price index in the urban areas. This is the all India figure, or if I put it in the bracket C, which means the CPI combined for both the urban and the rural spaces. This calculation is done by the National Statistics Office under the Ministry of Statistics and Program Implementation. These facts you can never ever afford to forget. On the other hand, there are certain other CPIs. Not all CPIs are actually calculated by NSO. There are CPIW. IW stands for industrial worker. There are CPIRL, which is the CPI standing for rural laborer. Then you have the CPIAL, which is the CPI agricultural laborer. These are worker-related CPIs. You see, you have industrial worker, rural laborer, agri-laborer. It's all speaking about workers, laborers. So obviously, it is calculated by the Labor Bureau under the Ministry of Labor and Employment. Now, what is the importance of this? CPI industrial worker. It calculates what is the average inflation that an industrial worker in India faces. It is on the basis of this inflation, the allowances and the salaries, largely the allowances of the industrial workers are calculated. Even the allowances of the public sector worker, PSU workers are calculated on the basis of this. Rural laborer, RL, this thing is used to calculate the allowances to be given in the rural spaces and how much it has to keep on going. And agricultural labor is about the agricultural wages. This is used for the fixing of the minimum wages on agricultural, etc., etc. Now you have WPA, or the wholesale price index. This is calculated by OEA, that is the Office of Economic Advisor, which is under the Ministry of Industries. Now, this slide gives you an idea about the weightages. On the right hand side, you have, for this portion, you have the WPA and its associated weightages. And on the left hand side, you have the CPA and its associated weightages. So what is the importance of this? See, any understanding of the divergence in CPA, WPA, which I'll show in the coming slides, demand you to understand the weightages of this. So we'll start with wholesale price index. Wholesale price index calculates the inflation on food articles, non-food articles, minerals, or this is like an even more detailed classification: minerals, crude petroleum and natural gas, fuel and power. And actually, they have three heads. You have the food articles, then they take these three together as manufactured products, then they have fuel and power. Three categories. That's a large categorical. You need not go into this much detailed categorizations, but if you want, you just kind of a look. Otherwise, they have the food articles or the primary articles. Then there is a manufactured products. Then you have the fuel and power. These are the three components. Now, on CPI, you have food and beverages. And not just that you have food and beverages, the weightage of food and beverages is 45%, whereas in WPA it was just 15%, which means if there is an inflation happening on the food and beverages component, it will reflect much more in the CPI rather than in WPI. Because the weightage given to that inflation component is so much higher in CPI than in WPI. And you have a newer component which is called as the pan tobacco intoxicants. This is not there in WPI. So any inflation on this will get captured only in CPI. Clothing and footwear, you do not have an explicit component like this in WPI. Housing is not there. See, housing is something, one of the very major expenses of people living, of the consumers, especially people living far away from their homes or in urban spaces and all. So CPI takes that into consideration, and CPI also have this category of fuel and light and also miscellaneous category. So the basic idea is, if the WPI has to go up, the components which receive the highest weightage in WPI has to go up. And if that is for the CPI, the components the highest weightage in that has to go up. So this is something about the divergence of CPI and WPI. Theoretically speaking, both WPI and CPI try to measure inflation. So inflation is going up, both WPI and CPI should go up. So similarly, if inflation is coming down, both WPI and inflation should come down, which means they should have a similar flow. That is, the direction of their movement should be similar. Like whatever direction one is moving, that should be the case. We normally see such an existence at least till 2015-16 and all. Then we start seeing a divergence. WPI increases after 2015-16, whereas CPI reduces after that. Whereas in 2018-19, WPI starts coming down, whereas CPI starts increasing. Why is this so? Because the composition is different. If the inflation is happening too much on the food component, CPI will go up, but not the WPI. On the other hand, if the inflation is happening too much on the fuel component, WPI will go up and CPI will go up later. And CPI going up will be lower. So if the inflation is happening on the imported component, if there is some imported inflation happening, suppose if you are importing crude oil and there is inflation on crude oil, this inflation will be first reflected in the wholesale price index. And after a particular period of time only, this inflation will get reflected in that of the CPI. So that is another explanation why these are not moving in the single direction. Theoretically speaking, according to the logic, these should move in one direction, but they are not. So why is that? So this could be a question that you get for the prelims. They could ask you to identify the factors which could be causing the CPI and WPI to move in two different directions. Okay. Now, if you have a look at the present inflation that India is facing over the past some time, this is the data till 2020-21. And if you have to have a look at the inflation after 2020-21, it has increased even further. Now, the relationship that of growth inflation, that's a growth inflation paradox, that whenever there is inflation, moderately higher inflation, or too high inflation, moderately higher inflation, the growth rate is expected, the economy is expected to grow. So that relationship largely holds, except in the circumstances of COVID, because inflation is a phenomenon that happens on the supply side as well as the demand side. So if you're speaking about the demand, when this theory which says about if there is inflation, there should be growth, this does not look into supply side dynamics. So in this period, I know I'm being a bit quick over here. I'm not explaining the whole narrative behind this. I'm assuming you know those dynamics. Okay. So in this period, the growth rate was coming down even when there was a decent inflation. Why is that so? Because there was inflation. Why was this inflation happening? Because there was a shortage of supply. Shortage of supply actually created inflation. When there is a shortage of supply, there will be inflation, but that inflation does not get captured or like converted into a higher growth rate. On the other hand, if there is good supply and the consumers are demanding more, for the same supply, demand would go up, and for the demand, the growth rate would go up. That is not what's happening over here. That's a difference. Now, so this is what has happened after the Ukraine crisis and all. You can see the inflation actually skyrocketing after from February 2021 onwards once this the Russian invasion of Ukraine happened. Now the image on the right hand side, I want to focus you over there. You have the months over on the x-axis. On the y-axis, you have the inflation percentages. You have four different plots. One is a CPI headline, the other one is CPI fuel and light, CPI food and beverages, CPI food and fuel. First, we'll start with the CPI headline, which is this red, black colored lining. So this thing, if you have a look, it has been fluctuating. What is this headline inflation? It's an inflation comprising of everything. So there has been fluctuations. Then you have a look at this CPI food and beverages, which is the green colored one. The fluctuations of the green colored one has been so much when you compare that with of this thing, like the headline. So basically, food and beverages on an average are more volatile than the headline inflation. And also, after the war happened, there has been supply chain disruptions on these food related products, and that added to that. Now, look at the red colored line. That's where you see the greatest dispersion happening. So it has been as low as close to 0% sometime, and it has went as high as something close to 15%. Around a 15% deviation in the CPI of fuel and light, because the Russia is a place you get a large amount of your energy coming, the energy resources coming. So once the war started, this started disrupted, and that's where the huge amount of inflation is happening. And not just Russian, the sources coming from Russia, on an average globally, there has been increase in the global commodity prices, especially that of fuel. That's why you see a huge thing over there. Now you see this blue colored line, which is relatively stagnant, like not much fluctuations you can see. What is that? That's a core inflation. That is inflation that you calculate by eliminating the most volatile components of fuel and light and food and beverages. And that is normally that is expected to be stable. And to be very frank, that is where the Reserve Bank's monetary policy has the maximum impact, because RBI can do nothing about food shortages. They can't go and farm. And also they can't do anything about this prices of fuel going up also. They can't go and start exporting all this type of things. So supply side is something that RBI can't take care of, whereas the demand side is something they can do of. Okay. Now, how has the government been responding in the recent times in the inflation? So government has allowed a pass-through of the imported inflation to the economy. What do I mean by that? So the imported inflation is largely happening on the fuel component. So government can either decide whether this inflation should be transmitted to the people, or they can absorb that inflation. How can they absorb? The absorption will work if the government reduces the excise duty on these fuels on which the inflation is happening. But the government chose not to do that. The government was more interested in the revenue aspect of it rather than the consumer welfare aspect of it. It might not be the baddest of things, but that's the underlying understanding. They reduced the taxes on crude oil. That was a very slight reduction, nothing compared with the price hike. So that's like an uncomparable. So RBI intervened in April. The war happens in February. The RBI intervenes in April to increase the interest rates. And RBI even increased the cash reserve ratio so that they can suck out the excess liquidity that exists. There were certain restrictions on the wheat exports, which were put to cool down the domestic prices, because Russia and Ukraine collectively are one of the biggest suppliers of wheat to the global market. So when the war happened, these supplies got disrupted, and there were wheat shortages in parts of the Middle East, parts of Northern Africa, etc. So the government forced, so there was a push for the export of wheat to come from India, because India had an ample supply of wheat, and there was a push for that. But the government was concerned this might push the inflation up, and the government decided not to do this. They put a restriction on the wheat exports. And the import duties on vegetable oils has also been reduced. We know the large sum of the vegetable oils that India uses come from outside, either from Africa or from Latin America or from the Southeast Asia. And those has been reduced. The import duties has been reduced, which helped control the food price inflation. Now, we'll have a look at this idea of standing deposit facility, extremely important. UPSC might not ask it this period, maybe because, but however, with a lagged effect, they might ask this thing, but it's extremely important to understand this. See, all of you must be familiar with Urjit Patel and the Urjit Patel committee that was established some time back. It was based on the recommendations of the Urjit Patel committee. The existing inflation targeting net framework was established. So Urjit Patel committee back then had recommended about something called as an SDF, or a standing deposit facility. So SDF is a liquidity management instrument. This is recommended by the expert committee to revise and strengthen monetary policy framework. That's what the technical name of this Urjit Patel committee is. So it's a liquidity management instrument. So I'm assuming you're very familiar with repo, reverse repo, marginal standing facility, and SDF. That's a recent entry. So you know how repo operates, exactly opposite to that reverse repo operates. And you also now know how MSF operates. What is an MSF? So if a bank is to hold the money, is to take money in excess of their repo allocation, like the repo limit, or if they do not have adequate collateral, they can go for the MSF route. That if the bank still needs to get money even without a collateral, the route they take is the MSF route. And what is the punishment of not having a collateral? You have to give a higher interest. So RBI, this thing did not have a reverse instrument. Repo had the reverse repo, but we did not have something called as a reverse MSF. And that's where the SDF fits in. So SDF is like, RBI would say, see, you banks, if you have excess money, you can park the money with us for 1 day or 7 day, whatever it be, similar to the reverse repo operations. But the difference that this has compared to the reverse repo is, in reverse repo, whenever you park the money with us, we will give you a collateral. But in SDF, we will not be giving you any collateral, but you will get your interest rates. But the thing is, in SDF, since we are not giving you collateral, we will offer you a higher interest rate than the reverse repo. So the idea is, RBI also at times fall short of collateral. So whenever the banks come with their money for the reverse repo operations, due to the fact that RBI do not have collateral to give to this bank, there has been instances where RBI has been forced to turn down those transactions. In that case, when you have SDF, RBI could now still take that money even when they do not have collateral. Now, what does this statement mean? It is a floor of the LAF corridor replacing the hitherto fixed reverse repo. So the upper ceiling of the LAF, which is the liquidity adjustment facility, LAF corridor, was the idea of MSF, just the most highest interest rate. On the lower front, now still you have reverse repo. But once SDF kicks in, no banks are going to opt for reverse repo. See, why do you need a collateral? If I'm giving my money to someone, what is the purpose of a collateral? The purpose of the collateral is to make sure that I get my money back. But here, you're giving your money to RBI. There is no need of a doubt that RBI is going to repay you. You're definitely going to get your money. In that context, SDF is going to offer a higher interest rate without collateral. Our reverse repo is going to offer a lower interest rate with collateral. But since the collateral is going to come up the most assured entity, the most trustworthy entity, people are not going to mind about the collateral and people will go and see only the interest rate. And the reverse repo operation will become redundant from now on. And that will be replaced by SDF. And now onwards, the lower floor would be SDF rather than the reverse repo operations. This is the whole idea of this. I have attached a link over there. When you get the slides, you can have a look at the link as well. Now, this is what it would look like. So this has been how the RBI's monetary policy, the repo rates has been operating over the period of time. So come COVID, they started cutting the rates, then it stabilized cutting the rates. Then it was in one, like, for a long period of time, somewhere around June 20 to April 2022, close to 2 years, it did not move. Then once the economy was on recovery mode, and when the inflation was starting to increase after the Russian invasion of Ukraine, they started increasing this. All the rates moved in tandem, the repo, the reverse repo, or the MSF. There was a slight desynchronization in reverse repo and repo sometime there. I hope you must be knowing the understanding logic of that and all. And this is where the RBI decides to introduce this MSF. And from now on, that is going to be the new floor and not the reverse repo. So next, we'll have a look at a concept which is called as stagflation. We'll continue our discussions on the inflation. So one thing that could be important is the idea of stagflation. So what is this thing called as stagflation? Normally, on the understanding of the Phillips curve and all, if you look at the recent literature, Phillips curve is something that does not hold. But the idea of Phillips curve is like high unemployment and high inflation cannot persist, right? They would say either there would be high unemployment or there would be inflation, not both. This was a conventional belief in the 1960s, but come 1970s, something else happened. There was this thing called as the oil price shocks happening. So the Middle Eastern countries were not happy with the US. This were on the basis of the geopolitical tensions that existed. You might be aware of the conflict, the Arab-Israel conflict and all, the Arab-Israel war, and the US was supporting Israel. And as a result, to cripple USA financially, the Arab world thought of, you will not sell the oil to the US, but you can't explicitly say that we can't sell you crude oil. But instead, they try to do it something else. They try to increase the prices. They increase it like fivefold, from around $3 per barrel to something close to $14-15 per barrel. And they were assuming that US would say no, because US would financially cripple when the prices increase so much. But US said, okay, fine, we'll buy you at this highest price. So when this happened, there was an inflation in the US market. There was an inflation in the Western economies as a whole. So these prices started increasing so much. So that was a time when there was inflation and there was already unemployment. So inflation and unemployment started to be seen to be coexisting togetherly, high rate of inflation and unemployment. So this is a violation of the Phillips curve, and this is the first time we were seeing something of this sort, and this is called a stagflation. Stagflation is actually a combination of two words, which is stagnation plus inflation. Stagnation in economic growth. When there is stagnation in economic growth, there will be unemployment and there is inflation. That's what stagflation is. So it happened initially in the early 1990s. Then it happened in the early 1970s, then in the late 1970s, and in the 1980s. So why is this thing important now? Now, if you have a look at the Indian economy and all, the post-war, the war, post-COVID, the war period, the growth rate is not very exciting. The unemployment rates are high, which means there is a stagnation. Also, there is an inflation. So this is a stagflationary situation that we are facing, not just in India, but around the world. And the world is experiencing it more drastically than that of India. That's the idea. So the economic survey actually pulls out a comparison between the present stagflationary crisis and the 1970s crisis. So why have I put this? I need to justify putting something very historical over here. See, the idea is you can't, it's not, UPSC is not going to ask you about the 1970s crisis and all, but UPSC has been asking questions about crisis. I have said it in my discussions on union budget and survey also. Every year, they're asking something about a currency crisis, global financial crisis, something of a crisis. So if you want to answer a problem about crisis properly, that needs a very thorough conceptual understanding, which is what this type of familiarization with the older crisis helps you. If you have a look at the 1970s crisis, It was a crisis of oil price shocks. Oil prices increased so much during those periods. Compared to that, these times, the oil price increase has not been so high. But however, in the 1970s, the crisis was due to an increase in the oil prices. Most of the other commodities did not face an increase in prices. But on the other hand, this time the crisis is happening across the commodity basis. Oil prices are increasing, the energy prices are increasing, all these type of prices are increasing. Now, when it comes to the third thing, it's basically about the commodity supply disruptions. So the commodity supply disruptions have played a smaller role now because if you look at the present context, the supply chains have become more robust, they are more adaptive, and become more efficient. So the slight disruptions of 1970s caused huge inflationary effects on the economy, whereas now, though even bigger disruptions are not causing that much of an impact considering the fact that the supply chains has improved. And another factor is in 1970s, before 1970s also, you had years of inflation. So it was periods of inflation followed by periods of inflation. But however, the present crisis is different. The present crisis, over the past some years before the COVID and all, the inflation around the world has been stable. So it is a period of high inflation, which is preceding, like you have periods of low inflation followed by a period of high inflation. Why is this thing important? When you are continuously living in a period of low inflation, your expectations of inflations are going to be lower. When your expectations of inflation are going to be lower, the inflation in itself is going to be lower. Whereas on the other hand, if you're living in a period of high inflation, your expectation of inflation are going to be higher. When you have higher expectations, it's going to be higher. That's the underlying logic, and that's how these things operate. So that's important in this context. Now we are done with the part of and banking, inflation, those things are done. Now we'll move to a couple of indices, very important indices on the industry. One is one thing you called as the IIP, or the Index of Industrial Production. Who calculates the index? That's the first thing that you need to have a look at when you see any indexes. Then you have a look at what is this index trying to say. Then you have a look at into what is the periodicity of the release of the indices. IIP is released on a monthly basis. And so then you have a look at what are the weightages or the composition of indices. So this is released by the National Statistical Office under the Ministry of Statistics and Program Implementation. So if you have a look at the composition of IIP, you can have like 5 categorization of goods. 5 types of goods are there in this index of industrial production. The one that gets a maximum weightage is that of the primary goods, which gets something like 34% weightage. What are these things called as primary goods? See, primary goods are the goods that are coming from agriculture, or not necessarily agriculture, even these goods coming from the mining, all the goods that are coming from natural resources come up over here. So if there is, how this gets reflected is, if there is an increase in the production of primary goods, there will be a growth in IIP. And what about intermediate? Then you have this whole category of intermediate goods. Intermediate goods are those goods which are later used up in the production process. Suppose you have steel, which is used in car manufacturing. You have glasses being used in automobile industries, construction, etc., etc., or concrete or cement being used up in construction. These are all examples of intermediate industries. You need to have an idea about these things. And you have final goods. Intermediate goods are not final goods because intermediate goods used up in the production process, whereas you have final goods which may be either consumer good or capital goods. The difference between a final good and an intermediate good is that a final good does not get used up in the production process. For example, you can take this pen tab and a stylus that I'm using. I'm using it to deliver a service, which means I'm using this in this productive activity. But The usage of this thing, this tablet in this service, or even this laptop in delivering this service, does not change the form of the laptop in itself or the tablet in itself. It does not consumes the laptop or the tablet in itself. Whereas when you're using cement in the construction process, after the process, you don't see cement, you only see the building. So the intermediate good gets consumed in the production process. It undergoes transformation. Whereas the capital goods does not, or any capital good is a subset of a final good. It does not get consumed. Another category of a final good is anything that you can think of. For example, you're listening to this lecture. It's a final service, not a good final service. You don't intend to do anything with this thing. Or you go and buy a packet of biscuit. You eat it. That's it. That's a final good, final consumption good. So you have final consumption good. You also have final capital good. Final capital goods are used in the production process, but they do not change form. And even the consumption good, you have the consumer durables and you have the consumer non-durables. For example, things that have a relatively longer lifespan, be it an automobile, be it the electronics, etc., they are considered consumer durables. Whereas consumer non-durables could be the biscuit that we are speaking about, could be the food that you are eating, all these type of things. So the basic idea of an IIP is composed of these type of different goods. So if the production of these goods go up compared to the previous period, then IIP goes up, otherwise it comes down. Now, this is one classification of having a look at what all is there in IIP. Another way of looking at is a sector-based classification. You have manufacturing, mining, electricity. So manufacturing getting the highest weightage, followed by mining and followed by electricity. Another important index to be considered is the ICI, or the index of 8 core industries. So the index of 8 core industries is actually calculated by the economic advisor to DPIIT, that is a Department for Promotion of Industry and Internal Trade, which is under the Ministry of Commerce. So you need to have an idea about what all are the components of this ICI, or the index of core industries, and what is the order of weightages. That is important. You need to know all these 8 sectors, and you need to know which sectors get the highest weightage. You have refinery products, electricity, steel, coal, crude oil, natural gas, cement, fertilizers. Why are these 8 industries called as core industries? Because any economy cannot function without these industries. For any economy to function, the existence of these 8 core industries are so vital, because it's on the basis of what happens over here. Without electricity, you can't produce anything. Without coal or crude oil, natural gas, cement, you can't produce anything. Even if you want to produce something agricultural, you need electricity, you need fertilizers. So that's why core industries is there. And in the core industries, the refinery products get the maximum weightage and the fertilizers get the least weightage. If you're not able to buy hard this 8 orderings like this, you should at least know what gets a maximum weightage and what gets a minimum weightage. That's uncompromisable. Okay. Now, we'll turn our analysis to a bit on the bond side of the story. UPSC has a history of asking questions on the bonds. So, what is basically a bond? What are the key parameters when it comes to looking about a bond? So a bond is basically an IOU instrument. Suppose I give my money to the government will issue me a bond saying that I have taken this much money from this person. That money is called as the face value of the bond. Let's say the face value of the bond is 1 lakh. I have taken 1 lakh rupee from this bond, this person, and the interest rate of the bond is 10%. That is, I'll pay this person a 10% interest, and that's called as the ACP, annual coupon payment. That is I will pay coupon payment. That's the interest of 10% on this 1 lakh to this individual. And this loan is going to be lasting for 2 years, which is a maturity time period of the maturity of the bond. So you have the face value, you have the coupon payment, you have the maturity. Then you have the frequency of coupon disbursement. The bond will also say, I will keep on giving the interest on a quarterly basis, which means 10% of 1 lakh is 10,000. Quarterly means every 3 months, the government will keep on giving me 2,500. Now, these are the basic idea of a bond. Now, there are two other important metrics, which is called as bond price, and the other one is bond yield. Okay. See, the face value of this bond is 1 lakh rupees. So the government issues this bond for 1 lakh rupees. But if I'm going to buy this bond, I may not see, suppose the government has issued to some person called as A. And this has been sold at 1 lakh. And I am planning to also, if B is planning to buy from A, he or she might have to pay 1 lakh or might not have to pay 1 lakh. Or it might be a different figure. When A is going to sell this bond to B, A would ask for 1.01 lakh. That is 1,00,000. Why? Because there is an interest on this. I have an instrument. I can hold this instrument. So government has issued it. After 1 year, the A is going to sell it to B. So A would say to B, see, if I hold this instrument for 1 more year, because the maturity here is 2 years, I will get 10,000 more rupees as interest. But now I'm going to give you this bond, which means that 10,000 rupee interest you will be able to get. So you can't just take away this bond by giving me 1 lakh. You need to pay a higher figure. I'll put it 1.05. You had to pay me 1,05,000 rupees. So after 1 year, you will get 1,10,000 rupees. So of that 10,000, I want at least a 5. So the price of the bond is not equal to the face value of the bond. It changes according to when the sale is happening, to whom the sale is happening. It depends upon the market conditions, basically. So that's what you mean by the bond price. Now you have an extremely important metric, which is called as bond yield. The bond yield is the relationship between annual coupon payment divided by the bond price. See, in this case, let's assume the bond price is 1,05,000. The annual coupon payment is 10%. Let's put it 10,000 divided by 1,05,000 into 100%. This, whatever figure turns out, that's what the bond yield is basically. Okay. Now, annual coupon payment, we know that's fixed. Whenever a bond is issued, the government or the issuing authority would say, this is the annual coupon payment out of it. That can't change. Then what can change? The price will change. See, the price of the bond will change according to the market conditions at the time of sale of this bond from one person to another person. If the person B is going to sell this bond to another person after 2 months, this person might not be selling it at 1,05,000 rupees. He might be selling it at maybe 1,07,000 or even 1 lakh or even 95,000, depending upon his conditions. So the numerator here, annual coupon payment, is fixed. The denominator, bond price, is a varying component, which means the bond yield is inversely related with bond prices. If the bond prices go up, bond yield come down. If the bond prices go down, the bond yield goes. So there is an inverse relationship that exists between the price of a bond and the bond yield. This you should be very clear with. Now, another thing that you need to understand is what happens in an economy when the inflation is increasing. So suppose if the inflation in the economy is increasing, the growth rate in the economy is also expected to be higher. Let's assume in 2022, government issues a bond and the government was saying the government would pay 10% interest. In 2023, the inflation has improved. The inflation has improved, the growth also is higher. So the government is saying, now we will pay 13% as annual coupon payments. Now, when there is inflation, but this 13% is coming from new bonds. Okay. We have a bond 1. Let's say there is a bond 1 that was issued in 2022. Now you have another bond 2, which is now being issued. See, the government cannot change the interest rate of 2022's bond, which was issued earlier, because that has already been issued. Now what the government can do is government can offer a higher interest rate to the bonds that are going to be issued in 2023. Now, there will be some people who is thinking about investing in bonds. So let's assume there is a person called as X. X is thinking about whether I should buy the bond 2 directly from the government, or should I buy this directly buy from some other person, Y, the bond. Should I buy bond 2 or bond 1? The bond 2 is with the government, bond 1 is with some other person. That does not matter. So I'm thinking, should I buy bond 2 or should I buy bond 1? Now, bond 2 have a higher coupon payment, which means it's going to offer me a higher interest rate compared with that of the bond 1. So X would say, I'll do one thing, I'll stick with bond 2 rather than the bond 1. So now what happens over here is, the bond 2 now gets the most of the attention. So the demand for bond 2 increases, which means the demand for bond 1 reduces. When the demand for bond 1 reduces, the bond price of bond 1 is going to come down. When the bond price of bond 1 is going to come down, the yield of that bond is going to go up. So that's the underlying relationship. So what happens whenever there is inflation? So similarly, this happens when the RBI increases the rates. When the RBI increases the rates go up. So the older bonds, the prices, there will be less in demand, their prices goes down, and as a result, the yield increases. So whenever the UPSC asks you a question about what happens to the bond yield or bond prices in situations of inflation, or in situations of some government intervention, RBI intervention, they are not speaking about bond 2 here. They are speaking about bond 1. Because people get confused. The RBI, whenever the UPSC asks what happens to the bond, some parameter of the bond, whenever there is some changes in the economy, be it inflationary changes, policy changes, whatever it be, they are explicitly referring to bond 1 and not to bond 2. You have to be very careful on. Because if you're thinking about bond 2, the whole dynamics changes. You have to be very clear that we are speaking about bond 1. And certain parameters of bond 1 are fixed, like maturity period, annual coupon payment, face value. This then cannot be changed. What can change? Bond yield can change, and also bond price can change. So relationship about the bond yield, the understanding is very important. Now, there is a concept called as a bond yield inversion. In order to understand bond yield inversion, I'll put you, we'll take two hypothetical situations. There is a bond 1 in the market offering 10% annual coupon payment. Another bond 2, which is offering same 10% annual coupon payment. For these bonds, all the parameters, the face value, coupon payments, everything is same except maturity period. So maturity period for the first bond is 1 year. The second bond is 5 years. So let's assume the economy is growing. What I would expect is, so which bond would a person X choose? The person X would normally choose a bond 1 over bond 2. Because if the economy is growing, that's on the assumption that the economy is good, growing. When the economy is growing, you expect the returns on the bonds to increase year over year. That is, if I'm getting 10%, like if the coupon payment is 10%, and if I'm getting something like 10% returns this year, I expect it to be maybe 12% next year, 15% next year, because the economy is growing, right? So I would never want to put my money in a 5-year bond, because in the 5-year bond, what happens is I will keep on getting only this 10%, even when the economy grows and the interest rate on the bonds would improve. Rather, if I buy a 1-year bond, I can just sell this bond at the end of 1 year. I will get my principal face value 1 lakh plus this 10%. Then with this money, I can buy a bond which has now a higher interest, 12%. the next to next year, I can buy another bond with 15% interest rate. So in the next to next year, 17%, next to next year, 19%. And this is how it operates. Whereas if I buy a bond with a 5-year maturity, this thing can't work out. I'm in sort of a limbo. I have locked in my money and I'm trapped. So normally, if the government or any entity is to sell a bond with a longer period of maturity, they have to offer a higher interest rate. The only way you can attract people to a longer term bonds in a growing economy is by offering a higher interest rate compared to the short term. This is a conventional notion. So if you have a look at the bond yield curve, in normal times, a bond yield curve would look like this blue colored line. So the longer the period of the long bond, it would have a higher yield. But however, there is some phenomenon called as bond yield inversion. So this is what we said for a growing economy. What if the economy is not growing? What if you think the economy is not, instead of growing, the economy is not going to contract? In such a circumstance, what you would expect is, you would think if I put my money, like if I'm expecting the next 5 years economy is not going to grow, so in that the relationship changes. So there it would be like, instead of this year government is offering me 10%, but next year I'm expecting a returns of maybe 8%, 6%, it's going to come down. But now I have another option, which is I have a bond of a 5-year bond where the government is offering me 10%. I'll buy this thing, which means I'll get this assured return. So when the prospects of growth in the economy is lower, people would prefer bonds with a longer maturity. The longer maturity bonds would sell even with a lower coupon payment and even with a longer yield. And that is exactly the concept of bond yield inversion. Bond yield inversion would say, it basically means the yield of the longer period bonds are now lower than the yield of the short period bonds, which is not the case normally, which is reflected in this figure with the help of this red colored line. That's it. Now we move on to a concept called as green bonds. Green bonds was first issued in 2008 by World Bank. So what is the idea of a green bond? So the idea of a green bond is to finance environmentally friendly projects. So if the government wants to fund some renewable energy project, they can issue a green bond. So this money will be used for the construction of this renewable energy project. So this can be issued by the central government, municipalities, etc., etc. You have something called as MGB, or the municipal green bonds. Municipal green bonds. So the municipal green bonds are actually issued by municipalities. And in India, the Ghaziabad municipality or the Ghaziabad Nagar Nigam has been the first municipality to issue a municipal green bond. So keep these facts in your mind. Now, certain projects are not eligible for a sovereign green bond. A sovereign green bond is a green bond that is issued by the sovereign authority. That's the central government. Now, if that bond involves the extraction of minerals, that's not eco-friendly. So those projects are not eligible to be issued a green bond. And also nuclear project, landfill project, biomass projects, etc., etc. The hydropower projects which have greater than 25 megawatt capacity. All these things, if you are going to raise the funds for these things, you can't use the issue of the green bonds. That's it. Now, you have a concept of social stock exchanges. You have the idea of stock exchanges. It has been existing for quite a long time. But Finance Minister in 2019-20 budget speech came up with the idea of social stock exchanges. It was an innovative concept. So the idea is, if you're a company who want to raise funds, you can list on the stock exchange and make money. But what if you are a company, you're a social enterprise, you're not a non-profit enterprise. Your objective is to promote like some social projects that have a social impact. Suppose if you want to promote a fund, you are an NGO or something, or non-profit organization, who is undertaking like school construction or providing midday meal things, or you're undertaking some environment friendly projects. In all these things, your focus is not profit. So when your focus is not profit, and when you try to list on the stock market, the normal BSE or NSE that you have, you will not be able to attract investors. You will not, because you will not, the investors need returns, right? So you will not be able to pay returns. So you will not be able to attract investors, and you will not be having money. So that's where the idea of social stock exchanges come. Social stock exchanges will have social enterprises. Social enterprises are non-dividend paying companies, which means if in a social stock exchange a company is listed, and if I give my money to this company, I will not be paid a dividend back. Instead, this social stock exchange, the company, social enterprises can use this money for some work of social commitment. Now, what is going to happen is the BSE and the National Stock Exchange both are going to have a subset of them called as a social stock exchange. Now, you will have a BSE social stock exchange and an NSE social stock exchange. So all these entities who are not dividend paying entities can come listed over here, but their focus should be the solution of social problems. You have social stock exchanges in UK, Canada, Singapore, etc., etc. So what are the conditions for any social enterprise to be able to participate in this? You should be a non-profit organization. And if it's a for-profit social enterprises, you should have a social impact as their primary goal. If you're making profit, that's not an issue actually, but making profit should not be your main motive. Your motive should be social improvement. And in the process, if you're making profit, that's fine. So SEBI has identified something like 16 activities like eradication of hunger, poverty eradication, reducing malnutrition, all these things, promotion of the rehab of this LGBT community, etc. All this has been identified as measures to improve to be identified as social enterprises. And you should be an entity which should be performing for at least 3 years period. You should be registered as a charitable entity. See, a charitable entity can't go and list over in a Bombay Stock Exchange, but they can list in the social stock exchange component of this. So it's like now these NGOs and all be able to raise funds in a more transparent. So, and one problem that the NGOs in India faces is they have a lot of funds coming from outside. So the outside funds are at times a bit of shady. They have certain wrong intents. They have intents of controlling, like certain religious intents, certain intents which are not always good in the interest of our nation. So the government goes on shutting those channels of investment and all, and the NGOs are suffering. But something of a social stock exchange comes up, so this sort of problems can be solved. There's more transparency in their funding process and all. So this social enterprises should be continuously disclosing their annual impact report, etc., etc. Now, since we're discussing about stock exchanges, I'll discuss about a term which has been in use for quite some time, which is called as friend running. Friend running and some other term is related term, insider investment or insider trading, which is something you must be familiar with. What is the idea of insider trading? See, suppose if I'm sitting in the board of a company, or if I'm working in a company, let's assume I'm a board member of a company. I would know about the proceedings of the board meetings. I would know about the future plans of the company. So suppose if the company is going to get a good project, which means it would improve the profile of the company, the company would perform better, the company's stocks would fare better, and those people who has invested in the company's stocks would be able to do it better, like get better dividends or returns. But since I am on the director board, I have this inside information. So if I spread this information to a group of my related people, and we agree tries to buy the prices of stocks of this company just before this news becomes in the public domain. When it's in the public domain, it's a level playing field. Everyone plays it out equally. But when you have this news earlier itself, we buy the stocks, we inflate the prices of the stocks. And as a result, what happens is some people will be able to make profit. Other people who come later will not be able to reap the benefits. So insider trading is discriminatory against the neutral traders who are standing outside. So it's in this something. So SEBI has banned this practice of insider trading. Something similar is what he calls friend running. See, there are certain brokers who have information of the orders of investors. For example, I do trading and I use this Geojit as my broker. So Geojit is one among the many broking firms. So all the orders that I have placed, like I would have placed an order to buy this stock at this much prices. So this Geojit would have access to a chunk of information from all the people who are trading on their platform. See, now Geojit thinks they know the market because they have information about these investors and they know these people are going to buy this at these prices. Geojit can use this information to make profit for them, not through the brokering activity, but by directly indulging in trading. Or you can give this information to someone related to you and then ask them to trade. That is illegal, and that's what you call as a friend running. You have this information and you run in front. That's friend running. Okay. I think I'll call it. We are close to 2 hours. I'll call it off for today. Now, what I'll do is the remaining portions will do in another session. You have all these things coming up. Thank you.